during the last recession, during the global financial crisis of '08, there was a lot of talk, at least early on, the same kind of point in the crisis as we are today, of catching a falling sword. I remember selling notes that were priced at a certain point to what we assumed the value was, and that buyers were buying them at what they thought was a discount to the value. But by the time we actually closed on the transaction, values had dropped so much that we now figured they were paying more. It was like catching a falling sword. If you think that the market is going to continue to go down, then maybe there is incentive to divest quickly, irrespective of the fee basis, right? Especially if you've got a fiduciary responsibility upstream. But if you do think that the market is going to recover, then there's incentive to hold on to it. Would you agree with that? That there may not be, for that reason also, the same kind of flood of distressed real estate, collateralized paper or real estate itself as there was last time?
Yeah, I mean, if you just think about the great financial crisis, it was 43 months in duration. What's this going to be? When you're in month 18 of the great financial crisis, you didn't know whether it would last for another year, another 2 years,
or ever end.
Or ever end. Exactly. This time, at least people believe that we know that this will be done in 12 to 18 months. But that's predicated on a lot of different things. And so I think one of the hardest things right now is just that. But I mean, look at the stock market. If you week before last, if you shorted the market on Friday week before last, you got your rear end handed to you last week. If you also were waiting to time the market and grab the tick back up, it rebounded quicker than anyone had expected. Now, I'm not trying to say in any way that the real estate markets act like the equity markets, because they don't. But at the same time, I think that it's also very, very difficult to sort of say anything you do right now is a falling knife, or the flip side to it is that anything you put money into right now is going to go up because we've already seen the worst of it. The debt markets typically lag the equity markets by a very significant amount of time. If you think about the great financial crisis, I believe that the equity markets hit their low in Q2 of 2009. And then they started a slow recovery. But if you look at when you look at high yield defaults didn't start really in big numbers until Q4 of 2009 and well into 2010. And the same thing with losses in commercial real estate. You really didn't see the market start to show its weakness until well into 2009 and into 2010. If you were watching the equity markets, you'd be like, everything's great, except for the fact that the defaults in the debt markets were then just starting to move through the system. So there's very much regardless of what you think about where the equity markets are and whether last week's rally was the beginning of the new, or whether we set back down and go below where they tested week before last, I'm not going to predict where that all goes. All I'm trying to say is equity markets usually sell off further than they should, and they clearly come back much before the debt markets do.